two other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Creating explosive energy and explosive growth. And I think in the crypto space, we're going to see blockchain technology and artificial intelligence converge and cause explosive reaction. We are on the threshold of an explosion in innovation, and crypto is symptomatic of it. The seeds for what is about to happen were planted during the 20 years that ended with the tech and telecom bubble. Those seeds have been gestating for 20 to 25 years, sometimes 30 years, and are now beginning to blossom. And that's not even the right word. They are exploding into existence. So we think there are 5 major platforms, 14 different technologies that are all getting ready to move into the sweet spot of their S-curves. And there are going to be convergences between and among these technologies. So you're going to have one S-curve feeding another, and creating explosive energy and explosive growth. And I think in the crypto space, we're going to see blockchain technology and artificial intelligence converge and cause explosive reaction. So it's pretty exciting. Just to get back to investing in the future, in other words, not adding much more value than the indices themselves. And the indices are where they are because of what has happened historically. The largest companies, the most heavily weighted companies in these indices are there because of their past success. But if we're right, and all of this disruptive innovation is about to explode, well, they are in harm's way. When all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world. And we see 3 sources of deflation. One is very good. It's called technologically enabled innovation. Artificial intelligence training costs are dropping 68% per year.
Right.
When a cost drops that much, the demand for it picks up, and artificial intelligence is probably the biggest reason we're seeing the convergences between and among technologies. So we've got one S-curve feeding another. Explosive energy, incredible deflation. That's the first deflation. But there are 2 other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have rights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the third source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other 2. But this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushback on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. What would be the productivity or the impact on productivity of the combination of these platforms? And what he's depicting here is the productivity uplift is going to be unlike anything we've ever seen. We've had multiple platforms evolving at the same time, only once before, and that was in the early 1900s: telephone, automobile, and electricity. And that world, that was the technologically enabled innovation of the time, and transformed our world completely. Let me put some numbers on where we are now. In 2019, when we did this chart, we evaluated the market cap around the world associated with truly transformative innovation. That year, it was $7 trillion. So it was less than 10% of the global equity market cap. That's public equity. The next year, last year, that doubled to 14 trillion. And we did have a very good year last year. We believe that in the next 5 to 10 years, that number is going to north of $100 trillion. But what we're not saying when so that's the upside. The downside will be in the broad-based benchmarks, which have been beneficiaries of the traditional world order and are now going to be disrupted and disintermediated.
I think I'd default still to Bitcoin because countries are now deeming it legal tender, and we haven't even put that into our thinking. Ether, however, is seeing an explosion in developer activity thanks to NFTs and DeFi. I'm fascinated with what's going on in DeFi, which is collapsing the cost of the infrastructure for financial services in a way that I know that the traditional financial industry does not appreciate right now. So it does have to move from proof of work to proof of stake. That transition is underway and seems to be taking hold. Here's how I'll answer that question. Our confidence in Ether has gone up dramatically as we've seen the beginning of this transition from proof of work to proof of stake. We'd still probably do 60% Bitcoin, 40% Ether. If we're right and companies continue to diversify their cash into something like Bitcoin, and institutional investors start allocating 5% of their funds towards, I'll just say Bitcoin for right now, because we did that, we framed it for Bitcoin, could be for other cryptos as well. We believe that the price will be tenfold of where it is today. So instead of 45,000, over 500,000. When all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world.
In the crypto space, we're going to see blockchain technology and artificial intelligence converge and cause explosive reaction. Evaluated the market cap around the world associated with truly transformative innovation.
I'm fascinated with what's going on in DeFi, which is collapsing the cost of the infrastructure for financial services